Hello, everyone. Welcome, welcome, welcome. We are so happy you are here. We have an amazing Fernando Angelucci here. But before I went into Fernando, I wanted to talk about a gentleman who didn't quite make his 100th birthday. His name was Charlie Munger. He lived here in Pasadena area. And he was, let me put on my glasses to read this. This article says, well, he worked with Warren Buffett, and Buffett's rule is don't lose money. Rule one, don't lose money. Rule two, look at rule one. He shared another rule that you may have missed last year in the Berkshire Hathaway annual report. Find a very smart, high grade partner, preferably slightly older than you, and then listen very carefully to what he says. And that was Charlie Munger. And Charlie advised Warren on many, many, many things. It's many times they disagreed on things, and they would sit down and talk about how things really worked, why you disagreed, what made it work. And sometimes Warren would go forward or Charlie would go forward like that. And one of the reasons that Charlie was so very, very successful was because he hired this young man called Chet Holmes, who wrote this fantastic book called The Ultimate Sales Machine. If you've never read it, I suggest you do, because he tells you what to do, how to do it. He gives you every step of the way, how to dress, who to talk to, how to talk to them. It's not one of these people that said, oh, I did this and I did that, and never gives you a clue. So if you can read anything by Charlie, he wrote a lot of books, or anything by Chet, which is this fantastic book. So like that. So welcome, everyone. I picked this one quote specifically for Fernando because when you hear Fernando's, well, he doesn't really give a whole lot of background that I know, but Fernando is somebody that is like Frank Zappa. Without deviation from the norm, progress is not possible. Wouldn't you agree, Fernando? Yes, I love
I
your
agree.
story. And you didn't tell us your story here, but let me tell you a little teeny tiny bit about Fernando because he's just this amazing young man. Fernando worked at Dow Chemical, a Fortune 50 company, rolling out a flagship project estimated to gross about $1 billion in global revenues. At that time, he was 23 years old. Fernando left the 9 to 5 job and started investing in residential real estate by acquiring residential rentals and renovating and then selling them on self-storage, which he is going to talk about today. Fernando graduated from the University of Illinois at Urbana-Champaign. Did I say that correctly? With a Bachelor of Arts degree in Technical System Management. Fernando currently resides in Chicago. And he has lots of family in Brazil too. So he's an international traveler.
That's right.
Fernando, I am, as you could tell, so excited to have you here because I think you're brilliant, brilliant. I love how you do things, that you are paying attention to the market and that you continue to pay attention to
people.
Take it away.
Yeah, I appreciate the introduction, Peggy. Just to give some more color on that, son of two immigrants. I was told that the way to go about life is to go to school, get good grade, go work at a Fortune 500 company, and then retire after 40 years. That's clearly not the best way to make money nowadays. So very early on, when I was 16 years old, I read Rich Dad Poor Dad, and that kind of put me onto my progression of running businesses and eventually investing in real estate. So what I'll be talking about today is self-storage and why I invest in self-storage. I'll just pull that open for everyone here. All right. Can everyone see that?
Yes.
Awesome. All right. So, like I said, a little bit about myself. Fernando Angelucci. I'm based in Chicago, Illinois. To date, we've done This is actually a little outdated. $235 million worth of self-storage, 1.8 million net rentable square feet. And I do invest nationwide. So of the last 53 self-storage facilities that I have bought and sold, it has been across 26 different states. So why do I invest in self-storage? Well, there's quite a few reasons. What we're going to cover today is 9 reasons why I invest in self-storage. The first being the highest return across asset classes, recession resilient, got great leverage, easier management, a fragmented market, low break-even occupancies, and easy eviction in quotes, and we'll see why it's in quotes here shortly. Very high sticky factor, and then ancillary profit centers. So let's start with the first one here. So highest returns versus any other asset class. So we're going to look at the 1994 to 2017 average annual return. These numbers have actually been updated just recently, but they're along the same line. So as you can see here, the S&P 500 over that period of time returned about 8% a year. When you look at multifamily, it did a little bit better at about 13.3%. And then self-storage at about 17.4, now up to about 18.2% return annually. Now that 4% between multifamily and residential to self-storage may not seem like a lot. As you can see, residential, industrial, multifamily, office buildings, and retail were all about the same type of return, about that 13%, give or take about 0.5%. But self-storage was about 4% higher. So what does that 4% compounding actually mean? So when you look at these self-storage facilities, if you invested, let's say, $100,000 back in 2017, or I'm sorry, in 1994, and see what that value would have been in 2017, you'll see that the S&P 500 would have returned about $500,000. Apartments a little bit better, about $1.8 million. Same thing with, office, industrial, and residential, so all in that same space. But then look at the difference of that 4% compounded. That $100,000 would have turned it into just over $4 million over that period of time. So 4% may not mean a lot, but once you actually start looking at the returns, it actually does. All right, second thing, it is extremely recession resilient. So 2007 to 2009, was a very tough time in the real estate sector for everyone involved. You can see that during that time, the S&P 500 dropped 22%. Multifamily, residential, office, they're at 6 to 8%. Industrial was 18%. Self-storage was only, 3.8% drop. Now, this was a study done by the National Association of Real Estate Investment Trusts. So REITs are very large, slow-moving beasts. They have a lot of debt wrapped up. So I knew a lot of self-storage investors during this time that made a fortune. So, why is that? And the reason for that is because self-storage is one of those asset classes that, it does very well when people are having times of transition. So if you're downsizing, if you are moving jobs, if you're moving cities, it does very well. But same thing when in very high markets, very good economic situations. People are increasing the size of the houses that they're living in. They're getting other job opportunities. They may be buying more stuff than they really need just because money is flowing. So self-storage does very well in both of those situations. One of the things that people say is, okay, well, how about during the pandemic? And I say, well, during the pandemic, there was some of the best years that we've ever had on record. 2021, we had 80% year-over-year rent growth. According to TREP, which is a commercial mortgage-backed securities research firm, of the 1,700 CMBS loans that were made to self-storage operators in the first 3 quarters of the pandemic, only 3 were more than 30 days delinquent. That's a 0.17% delinquency rate. During that same time, multifamily was defaulting at a rate of 1,800% higher, 18 times the default rate of self-storage. And we're starting to see that again now that we have this second wave of debt cliffs, where a lot of investors are running out of their 2 to 5 year balloon payments, and we're seeing a lot of multifamily deals being unable to refinance based on the numbers they thought they were going to be able to achieve when they first started those syndications 3, 4, 5 years ago. All right, number 3, safest loans equals better leverage. So we're going to cover the lowest default rate of any asset class over 2011 to 2018, lowest average loss per default between 1998 and 2017, and then why banks are fighting over each other to give us leverage. So the first is let's look at default rate per asset class. So the reason we looked at 2011 to 2018 is that 2007 to 2009 was the real brunt of the downturn in residential real estate. It took a long time for those defaults to actually be worked out. We started seeing a lot of those defaults between 2011 all the way up to 2015. So as you can see here, if you look at the average across all sectors, you're in that 5% range. The farther back you go, it's a little bit work out from all those defaults. But when you look at self-storage compared to any other asset class, look at the numbers. I mean, just in the January 18th or January of 2018, 0.04% default, whereas multifamily is at 1.83, hotel, retail 3 to 7%, industrial at 7%. So when banks see this and they have to reorganize their portfolio, but they still have to make loans because that's how they make money. The banks can't just stop making loans and be able to remain profitable. If you look back in the very bottom of the chart here, second quarter of 2011, you can see self-storage had a 4% default rate compared to the average across all industries, which is about 8.6%. Look at multifamily. 15% of all outstanding loans were default. 16% of all hotel loans. 10% of all industrial loans. So you can see some pretty stark numbers here. The second thing that banks look at is what is the average loss per default. So once a asset goes into default, if they end up having to do a sale, some type of foreclosure sale, how much principal is lost to the bank? How much of a wipe do they have to do? And again, as you can see, self-storage outperformed all other asset classes. From a disposed position at 1.5% as opposed to 5%, and disposed and outstanding, you're at a 0.86% as opposed to 3.36% average across the entire industry. So just to show you that not only does self-storage produce better returns, but it produces the returns at an asymmetric risk profile than other asset classes like multifamily, hotel, retail, residential. So because banks, when they're in times of trouble and they need to rebalance their loans outstanding, the easiest way to do that is to bring in healthy loans that are going to be safe for the bank and more profitable. And that's why we have banks that are constantly fighting over us as borrowers, even during the pandemic, even during the times when multiple banks were failing, SVB and SB Bank. These are all things that pointed towards the safety of self-storage. All right, one of the things that I love is less people equals less management. So I always ask, a show of hands, whose passive income is truly passive. And what I usually see is that many people's passive income isn't passive; it's active income. And then I also ask that show of hands, how many hours per week do you spend managing your passive income?
Yeah.
So one of the back in 2014 to 2016, when I was still operating many single family homes and multifamily homes, I looked at my, quote, passive portfolio, and I saw that I was spending close to 80 hours a week on my passive income. So it didn't seem very passive to me. at all. But then when I bought my first self-storage facility, this was in a far suburb of Chicago, in a town called Yorkville, Illinois. I spent about 4 hours a month on that self-storage facility managing it. I didn't have a third. I was doing the management myself with my partner Steven. That 4 hours came out to about $8,000 in NOI a month. So I was making about $2,000 an hour for my time. So that is what something is, is truly passive, not the other way around where you're working 2,000 hours to make $4 a month. So what I've noticed going through this industry now for almost 8 years is that many smaller facilities are unmanned and you can automate them. And that will allow you to get to these numbers that I'm showing you here. The facility that I'm talking about in this example, there was no gate, there's no lights, there's no electricity, there's no office. It was one of those things where there was just a sign on the side of the building. People would call when they want to rent. We'd let them know when the next available time that someone would be at the facility to open up a unit for them. And it was a pretty smooth operation. That facility I bought for $975,000. And 3 years later, I sold it for $1.7 million. So just to show you what type of returns you can get in this business. This is one of the things that I really love about our industry is that it's extremely fragmented, and that equals opportunity. So what does a fragmented market mean? Well, there was a 2017 study that showed there's roughly between 44 and 52,000 self-storage facilities in the United States. As an industry insider, we know that there's actually closer to 60 to 70,000 self-storage facilities in the United States, but many of those are miscategorized and were not able to be counted into these surveys. The interesting thing is how this ownership of, let's call it these 70,000 facilities, are broken down. 18% of the facilities, now closer to 20%, are owned by the 6 largest publicly traded REITs. These are the Life Storage Extra Space guys. These are Public Storage, U-Haul. You guys know the names. You see them all over the place. The next interesting thing is that 9 to 12% of the next 100 largest operators, which I'm a part of, own only 9 to 12% of the existing facilities, which means 70% of all facilities in the United States are owned by, air quotes, mom and pop operators. And that means that there's a lot of opportunity for aggregation. There's a lot of opportunity to buy facilities, run them professionally, increase revenue, drop expenses, maybe do an expansion, and then bundle them into larger portfolios to sell off to some of these, publicly or privately held REITs. The 3 T's. These are the things that drove me almost to insanity when I was a landlord. No tenants, no toilets, no trash. If there's any landlords in the audience, I'm sure you feel my pain. One of the nice things about self-storage is that there's very low break-even occupancies. So low to mid 30% occupancy for unleveraged assets, mid to high 60% if you put debt on that asset. And then there's also very low overhead, very minimal utilities. You don't have, multiple bathrooms, multiple roofs, multiple water heaters, multiple HVAC systems. Some facilities don't have any of these things. There's no carpet cleaning. There's no painting. There's no leaky faucets. There's no winter HVAC failures causing emergencies where, it could be negative 20 degrees outside. And if a tenant calls and says, my furnace doesn't work anymore, or my hot water heater doesn't work anymore, and it's, that could be a very dangerous situation that could put you in liability as a landlord. You don't get that fixed within, 24 to 48 hours, depending on the rules and the laws in your local municipality. So here's that self-storage facility I was telling you about. It was in Yorkville. We bought it in Q3, August of 2018. The break even at purchase. So we bought this unmanned, no offices, no utilities. We bought this from a broker. It was 35% occupancy unleveraged. We later put some debt on it. At 81% is when it was break even. Then we stabilized it. So we increased revenue. We did marketing. We dropped the expenses. We fought the property taxes and got them reassessed. We got a new insurance quote. And at break even, our stabilization, our break even was at 28% occupancy unleveraged and at 64% occupancy leverage. So the fact that it can pay the bills from operation with only 28% of the units being rented, and then pay the bills and the debt at 64% occupancy, that gives you a lot of cushion for if the markets go up or down, or if there's a pandemic, or if there's a another 07, 09 great financial crisis. This allows for a lot of downside mitigation. Eviction. This is another one that it almost hurts to see the word now as a recovering landlord. The reason evictions is in quotes is because there are no evictions in self-storage. We are guided by lien law, or property law, as it's known colloquially, as opposed to landlord-tenant law. So what does that mean? That means that the second someone puts their possessions into our self-storage unit, they de facto give us a lien against those possessions. And if they do not pay, the very first thing that happens after the 5 to 7 day grace period is that the access to the unit is denied until payment. So that if you have a gate, their gate code stops working. If you don't have a gate, the manager or your your boots on the ground will put this little red lock that you see on that, saying that this is an overlocked unit. You cannot open your unit without paying us first for us to take off our lock. If they do not pay during that grace period, then we start the auction process. Depending on the state, it could be anywhere between 30 to 45 days from delinquencies when you're allowed to auction off those possessions. And that will pay you back all of your back due rent, including fees. So you can charge a late fee, a lien release fee, an auction fee, a cleaning fee. So it's one of those things where you can't make a profit from this, but you can get back to zero, including all the time spent auctioning off these units. So the way that you turn this unit is by sweeping it. You can't do a lot of damage to concrete and steel structures, unlike, say, a residential unit where someone could pour concrete down the plumbing, and they can cut your electrical conduit, and they can throw paint all over your carpet. Tenants that have not paid you in a while and then are finally having to reap what they sowed and are getting evicted could still do a lot of damage to your unit. And technically, you can go after them in small claims court, but good luck ever collecting. This is coming from somebody that has done all these things. I don't say pour concrete down the plumbing just because that's a fun example that actually happened to us. And that was one of the reasons why we got out of allowing people to live inside of our investments. And then after that turn, you have a new customer 30 to 45 days from the date of the original delinquency, and you never miss a beat. So that's one of the reasons I really love self-storage. Okay. Self-storage also has a very high sticky factor. So what do I mean by that? Well, a $20 increase on a $150 unit is not worth the $500+ in 1 to 2 days to move from our self-storage facility to another self-storage facility down the street. You have to rent a U-Haul truck. You may have to take time off work, or in the very least, you have to waste the entire weekend. That's a big drag, and a lot of people don't want to do that. However, that 20% increase on a $150 unit, that's a 13% increase to the bottom line. Our expenses don't increase at all when we do rent increases. So that is pure profit. Now let's make the example for a rental property. Let's say that you were going to increase the rent on a tenant by 13%. Let's say on a 1-bedroom apartment in Chicago, you'll be lucky if you can get about $1,500 a month in rent. So would your tenant stay if you increased the rent by $195 a month on a $1,500 apartment? Probably not. They're probably going to go search for a new apartment building the second they're out of that lease. All right, and then the last piece here that I love is ancillary profit centers. So not only do you get to collect rent from the tenants at your self-storage facility, but you can make money in a whole multitude of ways. So you can do car storage, you can do RV storage, you can do boat storage, you can sell locks, You can sell renter's insurance. And when you sell that renter's insurance, you get to keep anywhere between 40 to 90% of that monthly premium. At all of our self-storage facilities, renter's insurance is required. So when they go rent one of our units, they have to show us proof of renter's insurance within 30 days of renting our unit, or else we will automatically put renter's insurance under their bill. And then we'll keep anywhere between 40 to 90% of that, depending on which supplier we're using. We can also sell moving supplies and packaging materials. You can run little FedEx offices, printing services, scanning services out of your site if you have a little office space. You could put cell towers on the unit, billboard advertisements, wine storage, which is a specialty type of storage. You can also do truck rentals. So, for example, you can use U-Haul. You can buy your own trucks and rent them out. Private mailboxes, propane filling. You can even have ATMs where you collect fee anytime somebody takes money out, and vending machines. And there's even more on top of this, but these are some of the ones that we use quite a bit, with some of my favorites being the cell tower and the billboard advertisements, because those require no additional manpower, and you just get a steady payment each month from a large provider like a AT&T or whoever is advertising on those billboards that you have on your property. So those were the reasons why I invest in self-storage. Highest return, recession tolerance, great leverage, easier management, fragmented market, low break even, easy evictions, high sticky factor, and then ancillary profit centers. But then people say, Fernando, that sounds great. What are the downsides? There's no way that this could be the perfect investment. And that's true. There are downsides to this investment. So how do we mitigate those downsides? Well, the first downside is going to come from compressed cap rate. Now, we have seen quite a bit of this over the last 10 years because we were in a 0% money policy from the Fed. Then they ratcheted up those rates very quickly, which allowed for some reasonability coming back into the market. Cap rates started to get a little less compressed, but they're still pretty compressed because this is an attractive alternative asset to, say, a multifamily or a hotel or office building. Those three specifically have not done very well in the post-pandemic world. Hotels are starting to gain a little bit back here, especially for those that were able to pick up those hotels when they were very empty. The next thing is that there's a competitive acquisition environment. You are competing against very large brokers, very large real estate investment trusts that are basically have a lower cost of capital than others do, and that allows them to drive that cap rate down. And then brokers stripping a lot of the upside out of these deals. So what is the solution to this? It's to avoid deals that are retail and to buy them off market direct from sellers. We buy over 93% of our facilities are bought direct from the seller, no brokers involved. And then to avoid stabilized self-storage assets and buy value add deals, because like we saw in that previous slide, 70% of the market is owned by these mom and pop operators that are not operating these things as efficiently as we can. There's an opportunity to counteract those compressed cap rates. The second big issue of three is oversaturation. We're seeing a lot of areas that are very saturated due to these land grabs, where the publicly traded REITs are trying to stake a flag in the ground so that once the population grows to a level that makes sense, then they can build a self-storage facility, or they'll build it now knowing that they're going to operate it at a loss for 5 to 10 years once the population catches up. Cheap construction costs. Now, construction costs have gone up across the board 40 to 60%. However, it's still much cheaper than building, say, multifamily. So as opposed to me spending $450 to $600 a foot in multifamily construction, I can achieve roughly the same rent per foot and only spend 125 bucks a foot building self-storage. So 4 times cheaper to build self-storage to get the same level of rent per foot. And then supply index dropping year over year. We're seeing this in very saturated areas like downtown metro areas, downtown Chicago, downtown New York. So what is the solution for this type of downside? And to mitigate it, just shows the importance of underwriting and feasibility studies. Not only does every deal have to go through 3 levels of internal underwriting in our company, but then the bank will underwrite it, and we'll get a third-party feasibility study ordered, so that will just make sure that there's no rosy-colored glasses on any deal, especially if it's a deal that has a large construction component. And then the last but not least, which we've teased here, is your real estate investment trust competition. They have unlimited capital needing to be deployed. It's not unlimited, but compared to what we have, it's pretty unlimited. When you can go out to Europe and raise, $500 million bond at less than 1% return as your equity, and then go get some large revolving lines of credit from Blackstone or BlackRock at sub 4%, below SOFR rates. You have a much cheaper cost of capital. The second thing is they have much longer investment timelines. They are okay with buying a facility and not realizing the profit from that for a couple of years. And that's, one of the issues for us is that we are not long-term hold investors. We want to increase the velocity of our investors' capital. We want to be able to rotate that money every 3 to 5 years so that you can get the maximum return and you start avoiding those diminishing returns. So, somewhat of a Laffer curve, if you will. So what do you do to mitigate these things? And this is where the importance of avoiding primary market, like a downtown Chicago, and going to secondary or tertiary market, like the suburb, Naperville, for example, or going to Columbus or Indianapolis or college towns where, like my alma mater, University of Illinois. These are areas that have a lot of growth, a lot of demand for self-storage, and the REITs aren't really paying attention to these markets right now. So that is the end of my slideshow. So we can roll right into the question and answer portion of this. Hope I didn't go too fast for you all.
No, it was great. Thank you very, very
Wonderful.
much. So I always have some questions, but before I bogart the whole thing, is there anybody who has any specific questions for our great speaker, Fernando? Okay. I don't see any hands up, so if you do, put your hand up, please, and we will call on you. Well, I have a few questions.
Let's do it, Peggy.
Let's see. Well, I have 2 pages of questions. So you said so how do you find I know this one that we're working on right now is and David has a question. So let me ask this, David, and then call on you. So you said you find off-market properties because you're working with the mom and pops. Is there a specific way that you find that? I mean, you have a team, so does your team have assignments of what they're supposed to do, and then what makes it? And then I know you probably look at a lot of things, but what makes it like this is a deal we're really interested in?
Yeah, so we market to the lower 48 states. There's not many self-storage facilities, right? There's roughly 70,000 of them. So that's a very manageable number to hit every one of them. And so we have a multi-channel marketing approach. So there'll be letters, direct mail that we send out, cold calling, text messages. We'll meet them at the state association meetings that happen once a year. We speak at the national conferences, so the National Self-Storage Association, as well as the National Inside Self-Storage World Expo. We speak at both of those. So we end up getting this brand recognition. And when we find these sellers, it can be a long sales process. It can be 3 to 4 years until they're ready to sell. And that's where it comes to, leading with contribution and making sure that you can offer value to them, even if that value is not just buying their self-storage facility. So that can be, connecting them with a great tax attorney that has some strategies to lower their taxable income, figuring out a way to structure our purchase so that it reduces their capital gains, recommending management companies if they're not quite ready to sell, but they also don't want to continue managing it themselves. So there's a whole slew of different marketing channels that we can follow. And then, we have a pretty large social media presence that, if you Google self-storage, we're bound to pop up somewhere. Instagram, Facebook, LinkedIn, TikTok, YouTube, it's all over the place.
Okay, thank you. David.
Sure.
Yeah, hey, Peggy. Got a question reference to your demographics, as you mentioned, the different asset classes.
Yeah.
Does
Sure.
mobile home parks, is it in your study, or is that something that was left out? I was just curious on the income on the strategies for the mobile home parks.
Yeah, we don't like mobile home parks, and I'll tell you why. When we were getting out of habitation-based real estate, so real estate where people are living inside of your assets, we looked at alternative, and the three things that we came to was mobile homes, self-storage, and data centers. And then we started calling people in those industries to tell us, what did you experience in it? Am I looking at this the right way or not? And what we noticed is that with data centers, it just required too much land, too much water usage, too much electricity. There were these kind of mega projects, so that was kind of out. Then when we looked at mobile homes, it looked like it was hitting some of the same metrics as self-storage. But then when I actually started talking to mobile home operators, they said, listen, Fernando, yes, on paper, you rent the lot to them and you're never a landlord. But in reality, that's not how this business works. People will default on their lot rent. You'll have to repossess their mobile home. And guess what? Now you have a tenant, or what it's called a park-owned home. So once you have a park-owned home, you're back to being a landlord and you're having all the headaches and troubles that you would as a multifamily or residential investor. So we just decided to not be a part of that industry.
Yeah. Yeah. If you don't want to be a manager, tenants.
No.
Back to the 3 T's, right?
Yeah. Does that answer your question, or?
Yeah, I was looking for more of the numbers part of it, as you mentioned, but yeah, I know it is a little bit more management intensive.
Yeah, so all these numbers that we're studying that we cited are from large associations. So the National Association of Real Estate Investment Trusts, and they did not study mobile home parks because it is a very small and niche industry where that doesn't have a lot of real estate investment trusts in the space. So I can't speak on the numbers for those. The only thing I can speak on is I don't want to get involved in that asset class because it's going to bring me back to nightmares of being a landlord.
Do you think that's the same on RV parks?
So RV parks are interesting. That technically falls under your self-storage type of investment. The only difference for us is we will not buy RV parks where people are staying in the RVs. So the only type of parks we buy are places where you can park your RV, but you're not allowed to be in it while it's parked at our location. Oh. Again, coming back to that liability thing of I don't want anybody living in or on my investments, right?
Okay, so self-storage, RVs.
Yeah,
boat and RV parking, we do a lot.
Mm-hmm. And one other question about that. What about truck parking, facilities, kind of that space, or I know storage is the same thing what you're talking about, but what about like truck parking, specifically like an asset class?
Yep. So we've looked at that. Truck parking is a very interesting business. Very similar again to what we do. We have spaces where a truck can be parked. If somebody wants to park it there. The only difference is, our main asset is storage, self-storage, and then we have an auxiliary income from allowing people to park trucks and boats and RVs, et cetera, on our additional land at these facilities. If you're doing a 100% truck parking strategy, It's a little bit harder because you have a lot of environmental concerns, the hydraulic fluid and diesel and things leaking off of those trucks constantly that are coming in and out, which can cause environmental issues on your land. So when you go to sell, if that shows up in the phase 1 or the phase 2, you may be spending a lot of money out of pocket to do remediation for the next buyer. The other thing is the locations need to be very specific. So typically where these truck parking locations are is on, intersections of multiple interstates. So that's usually pretty prime ground. You don't do truck parking, like 100% truck parking, because of some of the low barrier to entry, the land that's hard to source, and then the environmental issues that come along with it.
Gotcha. One last question. I'm sorry to take up a lot of time. What's the minimum size of units that you're looking to purchase, and why?
Yeah, so in our industry, we don't actually talk about units because you can have a 100 unit facility that each unit's 5 by 5, and that facility is not worth much at all. Or you can have a facility that has 100 units that are 10 by 40, and now that's a huge facility that could be worth 10 times, 20 times the value. So how the words that we use in our industry are net rentable square footage. Our minimum that we're typically looking for is 30 to 35,000 square feet of net rentable square footage day one, with the ability to add up to 65,000 net rentable square feet by the time we're done with our strategy. Because for us, we want to buy at sub-institutional quality assets, so 50,000 and below. And then when we go to sell, it to be certain size. We want to buy a thing that's smaller than 50, 60,000 square feet per facility.
So you have these, you've put this portfolio together, the 4 that you're working on right now, and you are going to add value in some way on those, are you not?
Correct. Yep. So you go from easiest to hardest value add. So the easiest stuff is right off the bat, getting rid of any expenses that are not necessary. You increase the rents. This will be by doing a market study, see what the competition is charging, making sure that you're spending money on good marketing campaigns, doing partnerships with local vendors like apartment buildings, pizza delivery people, just having kind of a very local market approach, because 60 to 90% of your customer base are going to come from a 10 to 15 minute drive time from your facility. So you're really pulling from a very small area. So those are kind of the very first easy things to do on value add. Then you start going into your CapEx, capital expenditures. So this is, making sure that you clean the entire facility, you pave the facility so that it's no longer gravel, but now it's asphalt or concrete. You're putting on new roofs, putting up bollards next to each door so no one can't accidentally back into one of your metal doors or metal dividers. And then on the last piece, then you go ahead and you put together expansion opportunities. So you can, let's say you don't have a lot of land, or the land that you do have has a bunch of encumbrances or easements running across. You can use modular units, so they can actually be lifted with a forklift, put into place, and then moved if anybody ever needs to get to that easement underneath it. If you have additional land, then you actually can build additional structures, which we do on about half of the facilities that we buy. And then from there, then you can also increase the value of each of the parts of your portfolio by increasing the size of the portfolio itself. Once you start getting to portfolios that are large enough, that are tight as publicly traded companies, back to what I said in my presentation, they have a much cheaper cost of capital than your typical buyer that will only be buying one facility. If you sell 10 or 12 of them together, you actually can compress the cap rate anywhere between 1 to 200 basis points, because of just the size of the transaction alone makes the parts worth more than the sum.
Thank you. So
Sure.
you have these. So I know you've done this in the past where you've put a portfolio together to sell off to like a REIT. Are you looking to do that with this kind of thing, with the 4 units, and then you'll add a few others to it and sell that off to a REIT, or is that because I know your people, when you do that, they make really good money, your investors.
Correct. Yeah. So what Peggy's referring to is we have an active investment right now where we are buying 4 facilities around 2 major Illinois state schools. So one is Illinois State University, the other one is University of Illinois, which is my alma mater. So we'll be buying those 4, and we're currently in talks, LOI right now, to buy another 7 along that same I-74 corridor. We have another 2 that we're in conversations with in Peoria, and then another 2 in Danville. So we're going to make a regional, somewhat central Illinois portfolio. Hopefully get it up to close to 500,000 net rentable square feet, and then sell off the entire thing to one of the larger real estate investment trusts or publicly traded REITs in that area.
You're so smart. Love it.
Thank
Yeah,
you.
Rick.
Yeah, quick question. So I've heard other people talk about storage units, and they talk about saturation rate. Is that a metric you use, and is it 5-mile radius? Is that where you're looking?
Yeah. So what you're referring to is what's called a supply index number, and how that is calculated is your net rentable square feet per capita in your trade area. So that can be, in a certain radius. For us, it's a drive time. So we structure our trade areas based on 5, 10, and 15-minute drive time from the facility. So instead of it looking like a perfect concentric circle, you have these larger chutes that go off of highways, so it's easier to travel faster. We don't use supply index number much anymore. The industry is actually moving away from it because that number can be misleading. For example, if you are in an area that is very densely populated, let's say somewhere that has skyscrapers, and you're looking at a 15-minute trade area, 15 minutes drive time in downtown New York is like 3 blocks, right? But there's a bunch of high rises with a ton of people, so that saturation number may be artificially high or artificially low depending on the area. So what we actually prefer to do is the following: we'll go to all of the competitors, and we'll see what their occupancy levels are. In our business, if you're above 92% occupied, you're actually you're not charging high enough rent. You'll never see a properly run self-storage facility at 100% occupancy, because you always want to have a couple units that you're trying to really push, kind of shoot the moon on the rate. And if someone's willing to rent at that amount, then you keep pushing it up and push it up until you find that equilibrium. So what we'll do is we'll go into the market, and if all of the operators are at 94+% occupancy, we know there is additional demand that is not being met in that market. The second thing that we'll do is when we go into those markets and we secret shop those competitors, we'll also look at their pricing. And we'll say, okay, is this person above 94% occupancy because they're charging way below market rents? Or are we not charging, up to market rent? And that's another way to see, so if we see all the competitors are at 94% occupancy and they're all pushing rate aggressively, that means that there's a lot of pent up demand in that area. And one of the easiest ways that you can gauge this is you just create a wait list and see how many people will sign up for your wait list in the area. And that's a better metric we have found than just relying strictly on the supply index number, which can be extremely misleading. For example, we have done deals in kind of very tertiary rural markets where the supply index number seemed very high because it wasn't very densely populated, but our facility, it was impossible to get below 100% occupancy. Every time a new unit came available, it was immediately taken. And that was the case with all of the operators that we were competing against in that market. So I think the supply index on that deal was like a 12+, which is very high. The average across the United States is like 6.9, 7.1, depending on who you talk to. Like I said, we will look at that number, but we give it maybe a 30% weight, and then we give a 70% weight to are the competitors full? Do they have wait lists? Are they charging market rents? Does that make sense? Cool.
Okay, good. Yeah, that was one of my questions. Do you keep a wait list? And I see why you do. That's actually a very important part of, specifically if you were going to sell.
Right.
You could say, look, I've got this wait list. Here's this list of all these people that are just waiting to get in. That's really
Not only that, but you can also, you can make a little coalition with all of the other operators or competitors in the area, and you say, hey, I don't have a unit, but if you're willing to travel an extra 7 minutes by car, I can pass you off to one of our competitors, and then on the back end, that competitor may pay me some type of referral fee, or they'll just remember that I did this, and then when they're full and we have an available unit, they'll send a tenant our way. I always say that a rising tide raises all boats or all ships. So I always joke that people ask me, like, why do you teach people to become your competitors? And I say, well, in our industry, it's one day you might be a competitor, and the next day you might be my partner on the project, right?
exactly. So build that
You know,
relationship.
yeah, I was talking about one of the ways that we're able to get off-market sellers to sell to us at prices below what they can get from a broker, and one of the ways of doing that is to help them defer or offset their capital gains tax. What we'll actually do is we'll buy the facility from them at a lower price, and then we'll bring them into our syndication as a limited partner and push bonus depreciation to them so they can offset the capital gain from the sale to us. So that gets our investor a better deal, that gets the seller a better deal, and we're still able to buy the property at a discount to market value by doing that structure.
Ah, that college education, huh? Yes.
My college degree was in agriculture and biology, so there wasn't a lot of negotiation skills in there, but I the school of the streets, right? Reading books
Yeah,
and Audible and
that's right.
all of that.
Yep, the checklist. Marcy.
That's right.
Yeah, Fernando, did I hear you say that it usually takes 3 to 4 years to complete a deal or a purchase? Question mark.
Well, not a purchase, but to actually complete our strategy. So anytime we set up, I'm an engineer by training, so I put a lot of contingencies into everything I do, and that includes time. Time is a big contingency that we use as well. So typically it only takes us about 18 months to do an entire value add strategy on an existing facility. It takes us about 3 years to do an entire lease up on a ground up development that we're building from scratch.
Mhm.
However, I'll add another 2 years on the end of that in case we have a pandemic or a couple banks fail all of a sudden. It gives us time to operate. So we'll always calculate our returns on a 5-year schedule, 3 to 5 year schedule, knowing that it's much easier to go back to an investor and say, hey, I know I promised you 16% IRR. Is it okay if it's 32%? They're always going to say, yes, that's fine. As opposed to the other way, if I'm trying to run these numbers with no contingencies and everything is, if anything goes wrong, and then I'm saying, hey, I promised you I'll get you a 30% IRR, but really it's going to be a 16% IRR. People are going to be a lot madder on that exchange than on the other one, right? So, to answer your question, an existing facility that needs to do value add, we need about 18 months. On a piece of land that we're going to build from the ground up, we need about 3 years, and then I'll usually put about 2 years of buffer on the end of both of those.
Got it. Thank you.
That's great.
No problem.
Eugene.
How you doing, sir?
How you doing?
Very good. So you sent me this Central Illinois. I'm on your list.
Oh, okay, great.
Is it too late for the Central Illinois? Because it looks like, because when I saw it was Fernando, I was like, I get an email from you once a quarter.
Yeah.
The Central Illinois deal, is that done? Is it fully funded? Because it looked like the email, I was just looking it up and said you're up until 5/15.
Yeah, no,
2024.
it's still open.
It's still open. Okay.
Just a little bit.
Oh, did I lose you guys?
You froze up for a minute, Fernando.
So Eugene was asking if that was still open, and the email you sent me earlier this week said you were still open. And I think you froze up again.
Hey, can you guys hear me? It looks like maybe the internet's.
Maybe. You keep freezing up, so it might be your internet. And we lost him. So yes, Eugene, we've been working with him on this, and yes, it's still open.
Okay. Yeah, I'm on his list of investors, so I get stuff from him all the time. And I just
Can
Oh,
you guys hear me now?
yeah, we can hear you now. Well, you're on
Sorry.
the list also, so you're
Yeah.
also getting from us, so you're getting doubled in.
Yeah.
Yeah, so if I think I caught your question, you're asking if the deal's fully funded. It's not fully funded. We did close on the deal already. We, like I said, we put contingencies into everything, so we'll usually raise a little bit more money than we actually need. So I believe Peggy, asked how much we had, I think it was like 300,000 left or 400,000
Yeah,
around that
400 is
that
what you
amount.
told us, right? You told us that.
Yeah.
So, yep.
Mhm.
So that's good. So who's got their, somebody's talking in the back. Yes, you have a question, Jonna? Okay.
I think
Anything
John was
else,
talking in the back.
Eugene? Eugene, anything else?
Um, no, I'm good. Thank you very much.
Okay, great. That's great. I just had a question about auctions because I know they have that TV show and yeah, well, which I've never watched. I'm just curious as to, because you said, if somebody doesn't pay in 3 or 4 days, they're in eviction mode. I mean, it's expensive to have somebody come in for one. Do you have a lot? I mean, how about that? Are there a lot of people that don't pay? And then you have to do an eviction?
Not many.
How do you
So the
determine?
only time we have a very large amount is usually when we buy a facility from a mom and pop operator that has just been letting delinquencies go because they don't want to deal with the headache. So that's the only time we have to do a lot all at once. There was a facility that we purchased in Indiana where day one of taking over the facility, we sent out a letter to I think 30% of the tenants saying, "Hey, you're behind on payments. You have 30 days to come, current, or else we're going to start the auction process." So some of them we got on payment plans, some of them became current, and then the rest we did a mass auction on all of them at the same time. What we do is it's actually not like the show anymore. So everything has become automated and online. So there's no, person, there's no, 4 or 5 people showing up and making bids. Everything's done online. We'll open up the unit. We'll take some photos without actually entering into the unit. So you can't cross the barrier. We'll close it again and put an auction tag on it. We'll post those photos of the unit onto these online auction websites, and then the people will bid on them online. The reason the online works really well is because now you have a lot more eyes seeing the unit. You can get a higher price than just waiting for people to show up for a physical auction. And then the cool thing, cleaning, no one ever has to show up. So once the auction is underway and there's an auction winner, that auction winner has to put a $100 to $200 deposit up front, and they have to clean out that unit within 3 to 7 days, depending on which state we're in. We follow all the state laws. And if they do not broom sweep it before leaving, we keep their deposit. Or if they do not take the information, or they do not take all the possessions, we keep their deposit and the money that they paid for the auction, and we start the process over again. So it's actually a pretty automated process. We have these special locks that we use that have a combination on the back with a serial number. So when the guy that bought the auction unit is there to collect, he just calls the management office. He says, "I'm looking at lock 4Q719." And we say, "Okay, the code for that one is 5112. They put in the code, it opens the lock. We say, hey, just leave the lock in the back of the unit once you're done. And then when the next rotation of our booth on the ground is through that facility, whether it's daily or every couple of days or weekly, depending on how it's automated and how it's run. That's how we take care of that whole auction without really spending a lot of manpower or hours on it.
Yeah, but you do have to have some manpower. So you can do it anytime, right? You could have just one and you'll do the one.
Correct. Yeah, we can do just one. Usually by the time we, our delinquency rate at a lot of our facilities are very low, sub 3%. Some of them are in the 1% range. And that I'll say it's due to the power of our management team and their ability to follow up in our call center and making sure that we're placing good tenants in those units to begin with. They're good customers, I should say.
What makes somebody a good tenant when you're applying? How do you know what makes a good? I mean, you obviously know, but tell all these people.
Yeah, so we're trying to make sure that we're getting them on a credit card auto pay as soon as possible, and we'll incentivize them. It's actually a penalty, but we rephrase it so that's an incentive. So instead of us saying, "Hey, if you want to pay with every month, or if you want to pay with a check or with cash, you have to pay an extra $5 or $10 to do that." So instead of that, we say, "Hey, the rent is now $10 higher. And if you'd like for this to get a $10 discount on your rent, sign up for automatic credit card payments," right? So what we have found is that the people that are auto pay, they basically never go delinquent unless something happens where they maxed out their credit card. But that gives us enough forewarning that we can get them out very quickly. And then you always, it's up to the manager as well. They ask a lot of questions. They ask, why do you need a self-storage facility? What are you going to use it for? And just through chit chat and small talk, you can see that we're going to be the troublemakers and who aren't. As a private business, we have the right to refuse to do business with anyone. So if we think that they're going to do something illegal or store something illegal or be just a bunch of a headache, for example, maybe they still pay, but they pay late every month and they refuse to pay their late fees, and that's accruing. I can just say, you know what, we're just going to cut it clean here. You have 10 days to remove your possessions from our self-storage facility, following all the state laws that we have to follow. And we have fired customers before that were just too much of a pain in our rear. They were causing too much use of the time of our managers and our call centers, calling in every month, sob story, why they need to waive the late fee that they're going to pay. So we also get, we have the ability to choose who we do business with, because the turnover process isn't as bad as, say, kicking out a tenant from an apartment building and then trying to get a new one. We usually have someone come in immediately.
That's great. So we are at the top of the hour. Does anyone have any last question before we go? Clarence, you've been very quiet today.
Well, I came in late, sorry. And I would just like to know, I understand he's got a facility for sale that you're handling.
Yes.
Yeah, just valuation metrics are interesting to me, but I figured that you already went over that at the beginning of the hour.
He did not go
No,
over
so this was
facilities. He did this as an education.
Yeah, just a purely educational kind of why we invest in storage versus other asset classes that we were a part of in the past, and decided to exit and no longer look back. But if you have any questions about individual investments or metrics, just talk to Peggy. She's got all the information.
Oh, thank you.
Okay.
No problem.
Great. Thank you so very much for coming on. We really appreciate it. Glad you're doing so well. And we will see what we can do for you, because we do have a few people that have some interest.
Wonderful. Yeah,
So
it was great talking with you all, and good seeing you again.
Yeah, we hope you come back
hope I can see you in person again. Yeah.
Yeah, we have a meeting in Beverly Hills in a few weeks if you're coming out this way.
Really?
office. Yeah, you could
Yeah,
be a
send
guest.
over the information.
Okay, great. You could be one of my guests. That would
That'd be
be
cool.
fun. And
I
you know,
love that.
Richard would love to see you. Yep. Okay, thank you everyone for being here. We will see you same time next week with our next wonderful speaker. Thank you.
Bye,
Bye-bye.
everyone. Thank you very much. We don't do